With the new Income Tax Act of 2025 just around the corner, it's absolutely crucial for us as professionals to get a solid handle on its key provisions. So today, we're diving deep into a really vital part of this new law, Section 89. It's a section that tackles a very common and practical problem in the world of capital gains.
Let's kick things off with a scenario I'm sure you've encountered. Imagine your client's property is compulsorily acquired by the government for, say, a big infrastructure project. They're owed a significant amount of compensation, but you know how it goes. Administrative delays mean the money doesn't arrive for months or maybe even years. So is that clock to reinvest the capital gains and save tax still ticking? Or has their window of opportunity slammed shut? It's a really high-stakes question that a lot of taxpayers are facing. So here's how we're going to break it all down. First, we'll talk about the core problem with the capital gains timeline. Then, we'll introduce Section 89 as the legal fix. After that, we'll walk through a really practical case study, cover the essential compliance points you need to watch out for, and wrap up with the key takeaways. Okay, let's set the stage here. The whole reason Section 89 even exists comes down to a fundamental issue with the standard rules for capital gains.
As you know, to claim those valuable exemptions, like under Section 82 for reinvesting in a new house, or Section 83 for certain bonds, the law is pretty strict. It says that the capital gains have to be reinvested or put into the capital gains account scheme within a very specific time frame. It's a hard deadline, no two ways about it.
And here's where the problem comes in. The transfer of the asset, the compulsory acquisition, happens on one date. But what if the money, the actual compensation you need for reinvesting, doesn't show up until much, much later? It just seems completely unfair to penalize a taxpayer for a delay that is totally out of their hands, right?
Well, this is exactly where the law steps in to provide a fair, common-sense solution. Let's take a closer look at Section 89 of the Income Tax Act 2025.
So here's the bottom line. Section 89 is basically a relief valve. Its entire purpose is to make things fair by extending the reinvestment timeline when the compensation from a compulsory acquisition gets delayed. It lines up the start of the investment clock with when the person actually gets the money. Simple as that.
Now, for those of us who have been working with the 1961 Act, this whole concept is going to sound very familiar. Section 89 of the new Act is pretty much a direct continuation of the old Section 54H. The substance of the rule hasn't changed. It's mostly a renumbering to fit the new structure of the law. So good news, it ensures a smooth transition for all of us practitioners. Let's be super clear about when this applies. Section 89 is specifically for cases of compulsory acquisition. We're not talking about a regular, voluntary sale of a property here. This is only for those situations where the government uses its legal authority to take private property for a public purpose, like building a new highway or a railway line.
The way it works is really simple and logical. Step 1, the acquisition happens. Step 2, the compensation is delayed. And Step 3, the law basically hits a pause button. The clock for reinvestment, whether you're looking at Sections 82 through 86, doesn't start from the date of the transfer anymore. Instead, it gets a fresh start from the date the compensation is actually received by the taxpayer.
All right, theory is one thing, but let's see how this actually works in the real world. A good case study will make this whole concept crystal clear.
So, let's imagine a client, a business owner, whose piece of land is compulsorily acquired for a big national highway project. The legal transfer is all done and dusted, but because of some procedural holdups, the government's compensation payment takes over a year to actually land in their bank account.
And this timeline just shows you the real power of Section 89. You see, the land transfer happened way back in January 2027. Without this rule, the deadline to reinvest would have passed in October 2027, long before the client even saw a single rupee. But thanks to Section 89, the timeline is completely reset. The clock only starts ticking in February 2028, the moment the money hits their bank. This gives them the full, legally prescribed period to make the reinvestment properly.
So understanding the law is half the battle, right? Making sure everything is compliant is the other, equally important half. Let's talk about the practical stuff that we, as professionals, really need to be on top of. Look, meticulous documentation is just non-negotiable here. You have to advise your clients to keep a file with every single piece of paper, the official acquisition notice, proof of the transfer date, and critically, the bank statement showing the exact date the compensation was received. And of course, keep all the records of the new investment. This paperwork is your #1 defense in any assessment.
Now, there are a few common traps you really want to avoid. First, make sure you're calculating the new timeline from the date of receipt,
Now, what does receipt mean? Is it the date on the check or the date the funds actually clear? The general guidance points towards the date of actual credit, so those clear bank records are vital. Second, always be ready to prove that this payment is directly linked to that specific acquisition. Third, and this is a big one, never forget this is a special provision. It absolutely does not apply to regular, voluntary sales. And finally, remember the rules for the capital gains account scheme still apply. They just start from this new, later date.
All right, let's pull all of this together and boil it down to a few essential takeaways that you can remember.
So here's the summary. Number 1, Section 89 is a critical, taxpayer-friendly relief measure. Its main job is to reset the reinvestment clock to the date the compensation is actually received. It applies broadly to exemptions under Sections 82 to 86. It provides direct continuity from the old Section 54H, which is great. And finally, never forget that solid documentation is the absolute key to claiming this benefit for your clients.
And that brings me to a final thought for you. With all the rapid infrastructure growth happening across the country, compulsory acquisitions are only going to become more common. So the fair and proper application of Section 89 isn't just a technical tax detail, it's really about balancing the government's development goals with the fundamental rights of taxpayers. It's a provision that's going to become more and more important as we move forward.
Thank you so much for joining me for this deep dive into Section 89. If you found this explanation helpful, please do like, subscribe, and share it with any colleagues who might also find it useful.
And just a reminder, this is for educational purposes only. Tax laws are always subject to change, so please be sure to consult with a professional advisor for your specific situation.